In the 2020-21 tax year, only 3.73% of UK deaths resulted in an inheritance tax charge, raising £5.76 billion. Inheritance tax receipts for April 2023 to March 2024 were £7.5 billion. So the statistics show that only a small proportion of UK deaths result in an inheritance tax liability, but the number is rising, as is the amount of inheritance tax being paid. So this is in part due to the value of residential property that often makes up the largest share of most UK estates. The average UK house price has risen by more than 70% between 2009 and 2022. Inheritance tax arises in respect of a person's estate when they die. The deceased is deemed to have made a chargeable transfer equal to the net value of their estate at the date of death. Inheritance tax is usually charged on the net value of an estate at a rate of 40%. So this net value is the total open market value of all chargeable assets owned by the deceased, less any debts, qualifying expenses, reliefs, and exempt transfers. There are different established methods used to ascertain the open market value of various assets for the purposes of inheritance tax. Debts. Deductions can be made for any lifetime debts of the deceased that were incurred for full consideration in money or money's worth or imposed by statute. Examples of some typical debts are unpaid taxes, utility bills, credit card debts, rent arrears, and mortgages. Debts and any expenses must be paid in full before any beneficiary receives an interest in the estate. A loan secured against a particular asset, such as a mortgage on a property, will be deducted from the value of the property instead of deducted from the estate generally. The cost of any testamentary or administrative expenses, such as the inheritance tax liability, the cost of obtaining grant of representation, or professional fees incurred by the personal representatives administering the estate, are not allowable deductions in calculating the inheritance tax. The reason for this is that they are not amounts owed by the deceased at the point of death. There is one exception where some relief may be claimed for the cost of obtaining foreign probate. Subject to contrary intention in the will, inheritance tax on UK assets will be paid out of the residue, whereas inheritance tax on foreign assets will be deducted from the value of the asset. A deduction can be claimed, however, for reasonable funeral expenses, such as the cost of a tombstone and an appropriate wake. The personal representatives may become personally liable for the cost of an elaborate funeral unless the residuary beneficiaries of an estate approve it. Exemptions. Legislation contains a number of exemptions that exclude assets from forming part of a chargeable transfer. They operate by permanently excluding an amount of a person's estate from the charge to inheritance tax. So some of these exempt transfers are transfers between spouses or civil partners, transfers to charities and registered sports clubs, transfers to political parties, transfers of land to registered housing associations, and transfers arising from the deaths by or on active military service. The transfer between spouses or civil partners exemption is currently restricted to £325,000 where the deceased was domiciled in the UK, but the surviving spouse or civil partner is not. The restriction will not apply where the non-UK domiciled spouse is deemed UK domicile or elects to be treated as UK domiciled for inheritance tax purposes. The exemption is not restricted where both partners are non-UK domiciled, although these rules are likely subject to change with the introduction of the new rules effective from 6th of April 2025. A charity is a body of persons that is established for charitable purposes, is registered under the Charities Act 2011, is under the jurisdiction of the court in the UK, the EU, Norway, Iceland or Liechtenstein, and whose management are fit and proper persons. If the deceased leaves at least 10% of their net estate to qualifying charities, the rate of inheritance tax levied on their estate is reduced to 36%. Reliefs. Business relief and agricultural relief operate to reduce the value of property comprising a deceased person's estate. They achieve this by reducing the value transferred by a transfer of value attributable to relevant business or agricultural property. Now, the general rule is that business property is not relevant business property unless it has been owned by the deceased throughout the 2 years immediately preceding their death, although this 2-year rule is relaxed where the property transferred replaced other business property and the aggregated ownership period was 2 out of the 5 years immediately preceding their death. Or the deceased became entitled to the property following a transfer from a spouse or civil partner, and their aggregated ownership period was 2 years or more. Or the deceased became entitled to the property following a transfer of relevant business property and the original transfer qualified for business relief. Relevant business property can be defined as a trading business or an interest in a trading partnership, shares in an unlisted trading company, shares in a listed trading company where the deceased owned more than 50% of the ordinary shares, and land and buildings or plant and machinery owned by the deceased and used in their partnership or by a company he or she controls. Business relief is given at 100% unless the relevant business property is shares in a listed trading company or land and buildings or plant and machinery, whereby it's given at only 50%. Individual assets used in the sole trade business of the deceased will qualify for 100% relief. The 2-year ownership test applied to sole trade business as a whole, so individual assets needn't be owned for 2 years each to qualify. Agricultural relief works in a similar way to business relief in that it reduces the value transferred by a transfer of value attributable to farmland and farm buildings. The relief is available to a farmer who owns the agricultural land and buildings and uses them in his or her own business, or to a landowner who leases the agricultural land and buildings to a farmer. Agricultural property must be used for the purposes of agriculture throughout the 2 years preceding death, or the 7 years if the farmland was tenanted. Agricultural relief is 100% of the agricultural value of the land. The agricultural value is the value of the property assuming it can only be used for the purposes of farming. It is not always the same as the market value, such as when the land can be developed, but it is sometimes possible to claim agricultural relief on the agricultural value of a farm and business relief on the balance. Agricultural relief is restricted to 50% where the property was leased to a farmer prior to September 1995, and at the date of the landowner's death, the lease had at least 2 years left to run. So there are a number of other conditions that must be satisfied for either business relief or agricultural relief to qualify. So this should all be considered in detail should an estate contain such assets. Allowances. Nil rate band is an inheritance tax allowance currently set at £325,000. It has been £325,000 since 2009, and it will remain £325,000 until at least April 2028. The tax rate applied to assets within the nil rate band is 0%. So the amount of the nil rate band available to a death estate can be reduced if the deceased had made lifetime gifts in the 7 years preceding their death, but we'll come back to this later on in the presentation. A residence nil rate band was introduced in 2017 to provide an additional allowance of £175,000 where a qualifying residential interest is closely inherited. A qualifying residential interest is a dwelling which has at some point been used as the deceased's main residence, and a qualifying residential interest is closely inherited where it passes to a lineal descendant such as children or grandchildren and/or their spouses, civil partners. Or if the property becomes comprised in a trust under the terms of the deceased's will, and a lineal descendant becomes entitled to an interest in possession in the trust property. So these conditions to qualify for the relief are not as straightforward as the headline conditions infer, so care should be taken when drafting the will to ensure that the intended legacies do not prejudice the availability of the residence nil rate band allowance. The residence nil rate band is tapered for estates with a value of more than £2 million. The relief is reduced by £1 for every £2 that the net value of the estate exceeds £2 million. In addition to their own personal allowances, if an individual is predeceased by a spouse or civil partner who left some or all of their nil rate band unused, a claim can be made for the unused percentage to be transferred to the last surviving spouse. It is also possible to inherit any unused residence nil rate band, even where the first death occurred before the introduction of the residence nil rate band allowance. So the nil rate band and the residence nil rate bands make it possible for a married couple to pass up to £1 million between them inheritance tax free. Let me introduce you to Liz. Liz is a 70-year-old UK resident pensioner. She has been predeceased by her late husband Billy, who unfortunately passed away 8 years ago. They raised 2 children, Jeff and Faye. Faye has 2 children of her own, Scott and Alice. Liz loves her family, but has never felt comfortable discussing her finances and is reluctant to do so with her family for fear of causing conflict. She has not sought any estate planning advice. Her estate consists of a main residence in London, valued at £775,000, a holiday cottage in Sussex, valued at £600,000, an investment property in Pembrokeshire, valued at £320,000, a share portfolio worth £400,000, and £188,000 of cash in her Barclays bank account. Liz has some debt in the form of an income tax liability of £5,000 and a £2,000 balance on her credit card. If Liz were to die today, the total value of her net estate, less an estimated £10,000 for funeral costs, would be £2,266,000. To ascertain a taxable estate, the available nil rate band and residence nil rate band need to be deducted. Liz hasn't created any trust, so her full £325,000 nil rate band is available. Under the terms of Billy's will, he made cash gifts of £25,000 to both Jeff and Faye and £7,500 to both Scott and Alice, with the balance transferring to Liz. These chargeable gifts utilised 20% of his nil rate band, being £65,000 out of the £325,000. Liz's estate benefits from the 80% unused nil rate band inherited from Billy, so we multiply £325,000 by 180% to arrive at a total nil rate band of £585,000. Under the terms of Liz's will, she will also make specific cash gifts of £25,000 to both Jeff and Faye and £7,500 to both Scott and Alice. Jeff and Faye will also be entitled to the residue. Because a qualifying residential interest will be closely inherited via the residue by both Jeff and Faye, Liz's estate will qualify for the residence nil rate band. Her estate will also qualify for Billy's unused residence nil rate band. This is available even though the allowance didn't exist at the time of his death. Because the value of Liz's estate exceeds £2 million, the £350,000 combined residence nil rate band will be tapered by £1 for every £2 over this £2 million threshold. The £2,266,000 net value is £266,000 over the threshold, so the £350,000 residence nil rate band will be tapered by £133,000 to £217,000. The taxable value of Liz's estate is £1,464,000, resulting in an inheritance tax charge of £585,600. Liz is of course upset to find out that by failing to plan, the legacy she would leave behind is not as valuable as she had expected it to be. A carefully considered estate plan will enable Liz to make an even greater difference to the lives of her children and grandchildren by her paying no inheritance tax.